What's up everybody, I am Jeremy and today I want to answer some questions. I've been getting a lot of questions lately and a lot of them are extreme newbie type questions, and that's fine. But I realize that most people that are getting into investing and stocks have no idea how everything works with stocks and the overall stock market. Some of these questions have been like, where do babies come from? Heaven, duh. Just kidding. Some of the questions I've had are like, can I sell crypto that I buy? That's the entire question. This one kind of blew my mind actually. I would not buy any type of investment if you're not sure if you can sell it. And the short answer is yes, you can sell any crypto that you buy. You can actually buy and sell crypto 24 hours a day, 7 days a week. The only thing is that you cannot short crypto unless you use a specialized broker like Kraken. And I'm not talking about, of course you can obviously short crypto in like the futures market or an ETF that represents a certain cryptocurrency, but I'm talking about specifically straight up crypto. Another question was, I thought I had to wait till the next day to buy or sell a stock. The reasoning behind this one kind of stumped me. No pun intended, because my last name is Stumpf. Yeah, another really bad joke. But I'm guessing that the subscriber that asked this question probably was putting in buy orders at the time he got off work or something, and the market's closed, so the broker is waiting till the next day during trading hours to place that order. If a stock has high enough volume, you can always buy pre-market and after hours. I'm going to get into this further in the video as far as what the trading hours of the stock market are. Another question was, how do I know if a stock is any good? Should I keep a stock? Basically what happened with this person is they received free stocks for using my Webull link and wanted to know if the stocks that they received were any good. Without diving too much into this, a good rule of thumb is take a look at a 5-year chart. Has it been declining? Has it been gaining in value? Especially over the last few years. I mean, we've had a major bull run in the last few years. And if a stock isn't doing too hot during this time period, One of the stocks in particular that this subscriber was asking about has dropped 77% in the last 11 years since it went public. So let me ask you that question. Would you keep a stock if it's lost 77% of its value since inception? And that is something else that I do, is take a look at the overall chart from when the company went public. So with all these questions, I realize a lot of people need some type of guide to check out, to see how things work. So let's start with stocks. A stock is basically a representation of a publicly traded company. So when you buy a stock, you're buying shares of a company. There are a couple ways to buy stocks. You could either call up your broker and have them assist you in purchasing shares, or you can just do it yourself. And the two different type of buy orders are going to be a limit order and a market order. A limit order, you get to set the price. You're saying, I want the limit of how much I spend to be this price in particular. A market order, you're basically saying, I want this stock right now at market price. Limit orders are great because you get to set the price of what you want to buy or sell a stock for. The only problem is if you're trying to get in or out of a position quickly, the price can move away from you and then you have to reset everything and adjust the price and try again. This can be terrifying if you're in a trade that's moving against you very quickly. Now with a market order, it's going to be filled as quickly as your broker can fill it. Now the downside is you might not get the absolute best price. This is called slippage. And in theory, someone out there could have a real out of whack price request. Basically, let's say a stock is trading at $1 and they put in, they want to sell these shares at $1.50. Well, theoretically speaking, it's possible that if you do a market order to buy something and you're trying to get it at $1, if there's this sell order that someone has put in for $1.50, which is 50% higher than the value at the moment or the going price, it's possible that you could fill that order and you might pay 50% above what it's actually going for. That being said, I wouldn't worry about it too much. Any good broker is always going to pretty much try to get you the best price they can. And I have never experienced this, but I have heard theoretical horror stories. Typically, if you're trying to buy a stock as an investment, I would just do the mid price. A mid price is going to usually show up with a lot of brokerages, and that's going to be the price right in between the bid and the ask price. If I'm doing some trading, that's usually like a big position on futures or something like that, and the price is like fluctuating a lot very quickly, very rapidly, I don't mess around with limit orders. I just do a market order so I can get in quickly. And when I'm trying to sell, I do the same thing. Market order, unless I'm way above and I'm thinking, okay, if I can just, I'm done for the day. I'm stressed out enough. I'm already profitable. If it hits this price, I will sell it. And then maybe I'll just put a limit order in. Otherwise, I just use market orders when I'm trading. So everything I just said is assuming that you are buying. Now the same can be said for shorting. Now shorting a stock is basically the reverse of buying. When you short a stock, you're actually borrowing shares from your broker. You are borrowing at a current price in the hopes of buying it back at a lower price. And once you buy back these shares, the transaction is done. It kind of sounds like if you're buying them back, you would still own them. Well, you never own them in the first place. You were actually borrowing them. So once you short and then you buy it back, the transaction is over. Just think of it as trading in a downward motion. Shorting a stock is really no big deal as long as it's a big name and there's good volume behind it. Because stocks like over-the-counter, OTC, or pink slip, penny stocks, those can be almost impossible to find shares to short. Typically, you need a specialized broker and the fees can be extremely heavy. Now, in order to short with any broker, you need a margin account instead of a cash account. I'll get into this later in the video. The main reason for this is simple, because with shorting, you can actually lose more money than you started with. If you're just buying or trading a stock normally, you can only lose what you put in. If you buy a stock at $100 a share and it goes to zero, you lost all your money. But if you short a stock at $100 hoping for the price to go down and it shoots up to, let's say, $300 a share, well, you already lost all your money once it hit $200. Well, now that it's at $300 a share, now you owe your broker 100% of what you lost already. So you've lost twice your money. So the amount that you can lose when shorting is actually unlimited. And that's why you have to have a margin account. Basically, a margin account, think of it as your broker giving you credit. When shorting, loss prevention practices are more important than ever. If it's going away from you, you got to have some type of stop loss. If it gets to whatever level, you have to cut your losses. Remember, hope is never a strategy. ETFs, or exchange traded funds, and mutual funds. What is the difference? Well, a mutual fund is actively managed, consisting of multiple positions in different companies. Whereas an ETF, or exchange traded fund, typically is not managed and either tracks something like an index like the S&P 500 or a group of stocks that could be bundled together, like a bunch of stocks that are in like a technology sector. ETFs are bought and sold just like any other stock in the stock market. And for the most part, mutual funds can easily be bought and sold as well. But restrictions do exist depending on the mutual fund, like if it's tied to a particular brokerage. Trading hours: the market opens up at 9:30 a.m. Eastern Time and closes at 4 o'clock p.m. Eastern Time. Now, with bigger stocks with higher volume, you do have pre-market and after hours action. Just know that liquidity is lower, so getting in and out of a position is more difficult. And the spread of the price is always higher between like the bid and the ask. The PDT rule, also known as pattern day trading rule. This is a big one if you do any type of trading whatsoever. The PDT rule states that no one can trade more than 3 intraday, that's also a day trade, no more than 3 per 5 days. But if you buy a stock and hold it overnight and sell it the next day, that is not a day trade. That is considered a swing trade. The way around the PDT rule with normal stocks is you have to have at least $25,000 in your brokerage account. One way around the PDT rule though is just have a cash account and only trade with cash that you have. Meaning if you trade with all of your money, you're going to have to wait till that money settles before you can use it again. So if you want to day trade and you only have a cash account, I recommend not using all of your capital. So to recap the PDT rule, you cannot trade more than 3 times in a 5-day period unless you have at least $25,000 in your account. If you try and you succeed to, you might actually get a suspension. And you don't want that. Imagine you bought a stock and now the price is plummeting and you're suspended for trading for 5 days or something and you can't sell the stock. One thing that makes crypto so popular is the fact that there is no PDT rule because crypto is unregulated. You could trade up to 1,000 times a day if you wanted, but I do not recommend doing that. Now, as great as this sounds, being able to trade crypto freely, you can only buy crypto unless you're going through a specialized broker, and I like to have the ability to short. Now, with the brokerage accounts, you have 2 major types, cash and margin. A cash account is default of what anyone gets when they open a new brokerage account. This means that with a cash account, when you buy a new position, you are using cash that is in your account. This might sound like, duh, Jeremy, but let's say you buy Apple one day and you have $100 in your account and you bought $100 worth of shares in Apple. One day it pops up 5% and you decide to sell it and, take your $5 profit. So you sell that. Now you have $105, and whatever ABC company is on a pullback, the price is down 10% for whatever reason, and you decide you want to dip by that. And let's say it's $100 a share. You have 105, so you're thinking, okay, I've got enough money, right? Well, with a cash account, you have to wait for that money to clear first. So even though you just sold that position in Apple, you need to wait for that money to clear before you can buy anything new. Now with a margin account, kind of think of it as a line of credit through your brokerage. This is where your brokerage can literally lend you money to buy new positions. And my favorite thing about margin accounts is you don't have to wait for your money to clear when you sell out of a new position. So you're free to buy away even if that money has not cleared yet. And as I talked about shorting earlier in this video, you need a margin account to short. Now you can probably understand why. Because with shorting, you might end up owing your broker. Therefore, you need a line of credit basically. Dividends, my favorite thing to talk about. One question I got from a subscriber was, I thought you could only make money when you sell a stock. Now my channel is specifically focused on dividend stocks. If dividend stocks did not exist, I would not be retired. So what is a dividend? A dividend is paid out by certain companies to their shareholders. This distribution in the form of a dividend is paid in cash directly into the account of a shareholder's brokerage account. So no, you do not have to sell a stock in order to make money in the stock market. Watch my Warren Buffett video to show how much he makes from his top 3 dividend stocks. Okay, so I think I covered most of the basics. Please let me know in the comments if I missed something or if you guys want to know about anything. Of course, there's a hell of a lot more to know regarding all kinds of stuff. Crypto, futures, bonds, all kinds of stuff. But I don't want to make like a 3-hour video covering everything. So I'm trying to do this in baby steps. So make sure you've hit that bell icon and you've subscribed to my channel so you don't miss any new information. And if you would please like this video, it really appeases the YouTube gods. And with that, I will be back in a day or 2 with some more videos on trading and investing. But until then, be kind to one another, stay safe in this crazy world of ours, and I will talk to you later. Bye-bye.
Cuckoo, caca.
Baby, baby.